Go first to the markets. Closed, of course, on Good Friday and Easter Monday, but a lot happening in the all-important US market and with our big banks. Matt Kidman from Centennial Asset Management joins me live. Matt, welcome there. Well, we've had another extraordinary last week, although a short one. Wall Street finished up on Thursday with the best week in over 40 years.
Incredible, isn't it? And it's been funny because the market took 32, 33 days to lose 35%. And then it's regained, this is in the US, regained half of that in 17 days. So the rally's been as quick as the fall, which is quite amazing. And last week kind of topped that off.
Right. What was behind it? I mean, to what extent this enormous, $3.6 trillion Federal Reserve package was part of that growth in confidence?
Yeah, it definitely was part of it. And, you know, the old adage, don't fight the Fed. Does it work in this scenario, which is slightly different to what we're used to, or a lot different? It seems like the Fed's winning. They had that huge package that everyone was waiting for, but it came in on Thursday, and it was very broad, it was very big, and they liked it, but they didn't get carried away. It was kind of baked in a little bit in the lead up. I think also they're getting comfortable at last in the US. I think the US is behind everyone, just like their numbers are, about the virus. I think in other countries, comfortable in the sense that they know where a peak is and what the damage is done. And combine that with a little bit of stabilisation on oil for the Americans anyway, and the fact that the Fed is out shooting its biggest bazooka it can find virtually every week at the moment, is all very positive for the market in the short term.
You mentioned oil there. Of course, we had that meeting on Thursday, and there was great hope about Russia and Saudi Arabia, perhaps in OPEC's talks, getting over their little problem. To what extent was there any joy from that meeting?
Well, it's ongoing, isn't it? I'm not sure where they'll end up. I think the realisation is with them now that it's just not a story about trying to hurt the Americans. It's not a story about squabbling. It's about trying to bring everyone together, because world demand for oil products is down 30-odd%. I think they know that they're in for a longer haul. It's not a short kind of hurt the American producer, get back the stranglehold on oil that the OPEC countries had going back maybe a decade ago. I think they realise now that the oil price is going to stay pretty low. I don't think it screams down into single-digit numbers per barrel, but to get it up into a meaningful position where people can make money is going to be difficult in the short term. And I think that realisation is now with them. It doesn't mean they'll get across the line. They're talking about 10 million barrels production a day. That's a big number. They're working towards it, but they're trying to, twist the American arm also, saying, well, you guys have got to commit to something. So it's not quite there, but you would think that side of it is coming together. It should get there, and oil price may just it'll trade on good or bad news on a given day. But if we look at a trend, it probably stays in the 20 to 30 odd dollars a barrel for quite a while, just because of the demand scenario, I would have thought.
Right, so pulling it back to our market, obviously we open again on Tuesday, but we've had a major sort of rally, or a bear market rally, if you like. Is it a sucker's rally?
Yeah, that's the question everyone's trying to work out. In a normal environment, and I think this time, it is different this time, in the sense that we haven't had since the Second World War a government-induced shutdown because of an external event. So it is different, and the fall was enormous. I mean, the only thing we could find that looked something similar was the 87 crash, which started in September 87 and didn't bottom till February. So that was 5 months. We've only had, as I said, probably 7 weeks now, and we've gone down and back up. Is it a bear market rally? Well, maybe. I think given the nature of it, the only thing we can say, Tiki, is whatever's happening, it's compressed. Things are happening quicker this time because of the nature of the event. It's a bear market. It's fallen enormously, very quickly, quicker than any other time in history virtually. It's rebounded at a rate as quick as any time in history. So we kind of gets the feeling we will know the answers to the bear market rally, or is it the beginning of a new bull market? Probably within another 4 or 5 weeks, I would think, because everything's so compressed and everything's moving quickly. I think the strategy's got to be that you can't take a bet on that. Yes. Earnings are going to fall somewhere between 25 and 50%. It all depends on how long we've locked down for, how quick can we come out, and the conversation has changed. So the virus has kind of taken a back seat for the moment, and it's all about how do we come out of this. And if it's only 2 or 3, 4 months that we can get back up into something normal, And I would say that would be 75, 80% of normal, because international travel's not going to happen in a hurry. So things won't open for 12 months. But if we can do that, then maybe we can struggle on and keep going higher. If the conversation is that it's going to take more than 6 months, this is definitely a bear market rally and we go lower. Over the next 5 or 6 weeks, I would be a buyer of stocks, whether it rallies or it dips, because we will know the answers and we'll get through most of it in 5 or 6 weeks. So you'll either buy lower or you'll keep buying into a strengthening market where, on the other side, zero interest rates, any growth is going to be better than holding cash. That argument will come back in. So I think it's a buying period rather than a buying day.
Matt Kidman, thank you for joining us live on this Easter Day. Happy Easter.
You too. Thanks very much.